Smith+Nephew's latest update changes the question for shareholders. This is no longer simply a story about whether cost-cutting can restore margins. The company has cut its 2026 revenue growth forecast to around 4% from about 6%, after second quarter underlying growth came in at just 1.6%. The shares fell roughly 7%. The uncomfortable part is that the profits look better. First-half trading profit rose 8.1% to $566 million, while the trading margin improved to 18.3%. Efficiency savings reached $130 million, with the full-year target lifted to about $200 million. Smith+Nephew has therefore shown it can protect earnings while revenue momentum weakens. The new question is whether that resilience is buying time for a recovery or disguising a deeper growth problem. The clearest weakness is in U.S. orthopedics. U.S. knee implant revenue fell 7.2% in the second quarter. The company says customers are shifting towards cementless products ahead of new launches, including the forthcoming Landmark system. That creates a plausible temporary explanation. Hospitals may be delaying purchasing decisions until the new platform arrives. U.S. hip revenue also fell 1.5%, with delayed deployment of surgical instrument kits following 4 quarters of above-market growth.
But the explanation is not entirely reassuring. After 3 years of cost cuts and sales initiatives, Smith+Nephew was supposed to be converting operational improvement into stronger growth. Jefferies described the update as a backward step and said the long-awaited improvement was still lagging. The company is now relying on product launches later this year and through 2027 to fill portfolio gaps. If those launches merely restore delayed orders, the business may recover. If they fail to change customer behavior, the revenue downgrade will look less like a pause and more like a warning. There is a second problem in advanced wound bioactives. Revenue fell by roughly 12.5% to 12.7%, as revised U.S. reimbursement rules for skin substitutes weighed on sales. Smith+Nephew expects the reimbursement impact to reach the upper end of its previously guided $20 million to $40 million range. It expects skin substitute revenue to stabilize in the second half and normalize in 2027, but that is another part of the recovery that remains ahead rather than visible in the numbers.
The counter-evidence matters. Sports medicine and ENT revenue rose 10% to $527 million, supported by demand for shoulder repair products, and several product platforms delivered double-digit growth. Tariff effects are expected to be broadly neutral to trading profit after refunds, while management has maintained its targets for around 8% trading profit growth and roughly $800 million of free cash flow. So this is not evidence that every Smith+Nephew franchise is failing. It is evidence that strong pockets are currently having to compensate for weaknesses in knees, hips, and wound care. For a holder, the distinction is important. Cost savings, margin expansion, and the dividend provide some protection while the growth story is repaired. But the company's financial resilience does not by itself prove that demand has returned. For someone watching the shares, the central test is execution. Do U.S. knee sales improve once the new products launch? Do delayed hip deployments convert into revenue? And does wound care revenue stabilize as promised? The next meaningful evidence should come from those observations, not from another round of savings announcements. Smith+Nephew expects second-half revenue growth of 5% to 5.5% and says Orthopaedics should accelerate later this year and into 2027. Its new UK wound care factory is due to begin operations in 2027, while management still expects 6% to 7% revenue growth in 2028. Until those milestones appear in reported sales, Unresolved Reading is unresolved. The current weakness may be a product transition shock, but the company has not yet demonstrated that it is only that.